No long-term investment strategy can be complete without taking the effect of inflation into account. The dividend growth investing approach you've just learned provides a built-in inflation protection, but you should still understand how this works. That's why I created this bonus video. Looking at the official inflation statistics can be really frightening, as you can see that the dollar has lost most of its purchasing power since 1913, when the Fed was created. It is easy to calculate that you need about $24 today to buy the stuff that could be bought for a single dollar in 1913. And these are just the official inflation stats, which many say are getting harder and harder to believe. If you visit the website shadowstats.com, you can see how the official and their own stats are diverging. I won't tell you who to believe, since it wouldn't be credible from a 34-year-old Hungarian economist like me. I just wanted to highlight that the problem is real and needs to be addressed. It is always wise to listen to the most successful investors in the world whenever we encounter a problem like this. Warren Buffett's letter to Berkshire shareholders he wrote in 2011 gives a detailed and easy to understand answer to how the super investor thinks about inflation and the risks of investing. First of all, investing means that you do not spend your money today so that you can buy more stuff later. It is all about increasing your purchasing power, otherwise why would you choose delayed gratification over the instant one? While most people panic when stock prices fluctuate wildly, Buffett says that this volatility is not risk as long as you can reasonably expect your purchasing power to increase over the holding period. Permanent loss of your investment capital or decreasing purchasing power mean real risk, while fluctuating prices are simply part and parcel of the game, and if you have a long enough investment time horizon, you shouldn't bother too much about them, just take advantage of the opportunities volatility can provide. Buffett says there are three major categories of investments. The first one is made up of currency-based investments like bonds and bank deposits. People think of these as risk-free assets since their prices do not fluctuate wildly, but the truth is that inflation eats away your purchasing power. Bonds that are supposed to offer risk-free returns are now priced to deliver return-free risk. The second category involves assets that are not producing anything and people only buy them because they expect that a greater fool will come and pay more for them in the future. This is speculation and not investing. In this category, timing is everything. Think about the tulip mania of the 17th century or look at gold's price chart and you will see what Buffett means. It is worth noting that the first two categories enjoy maximum popularity at peaks of fear. We all heard cash is king in late 2008, just when cash should have been deployed rather than held. Buffett clearly prefers investing in productive assets like businesses, farms, and real estate. These assets should have the ability to deliver output that can retain its purchasing power value in inflationary times. I will show you an example in a few minutes. Understanding this line of thought is crucial, I believe. Whether the currency a century from now is based on gold, seashells, or a piece of paper, people will be willing to exchange a couple of minutes of their daily labor for a Coca-Cola, for example. People will always sell some of their time for money, whatever it may be, and will always use the money they earn to satisfy their needs. I have some framed banknotes on my wall, constantly reminding me that the perception of value can change very quickly, and as Walter said, paper money eventually returns to its intrinsic value, zero. So hoarding cash is a mistake that gets punished time and again. It is much more wise to invest in wonderful businesses, commercial cows, as Buffett says, that will live for centuries and give ever greater quantities of milk. Their value will be determined not by the medium of exchange, but rather by their capacity to deliver milk. As throughout this course I advocated that you should invest for the long run, it is good to know that productive assets like dividend-paying companies are expected to be the runaway winners over any extended period of time. And although stock prices can and will fluctuate wildly, the risk of losing purchasing power is minimal in this category. So the safest investments give you the highest returns if you free yourself from the volatility panic that freezes most people. The main conclusions are the following. Volatility, which means price fluctuation, is not risk. Risk is the probability of permanent loss of capital and purchasing power. In fact, volatility can be your friend. Remember what Joel Greenblatt said. Prices fluctuate more than values, so therein lies opportunity. Strong companies have the pricing power to protect you against inflation. You can see how McDonald's managed to hike the price of Big Mac by more than the inflation rate. If you need further evidence to back up the pricing power of the top quality companies, I suggest that you should do a Google search on Disneyland ticket price increases, for example. I believe, based on what you've seen so far, investing in productive assets that deliver the best returns while offering protection against inflation is a no-brainer. You can sleep well, count your increasing dividends, and let others have nightmares about a possible dollar crisis. Dividend investing is about letting compounding do the work. Your productive assets are working to preserve and even increase your purchasing power while you can relax and live a meaningful life.